Greetings, members one and all of the Salivation Nation. The dollar is strong, and the bond yields have sent gold to a 5-week low. 10-year Treasury yields have pushed above 3%, according to this article here from MarketWatch. And gold prices, they'd settled lower Wednesday, with rising bond yields and a firmer dollar, sending prices to their lowest finish in 5 weeks. Gold futures had clawed higher Tuesday after 3 consecutive sessions of declines, even as Treasury yields, which tend to move inversely to precious metals prices, broke above 3% for the first time since January 2014. And this particular yield here is up 0.88%. Weighed in on gold with higher moves Wednesday, reaching 3.029% with Wednesday dealings. Heavy price action in gold is due to a combination of rising rates and a stronger dollar. Tyler Ritchie, co-editor with the Stephen Sevens report, told MarketWatch. Gold has been pinned in a tight range between 1310 and 1360 all year. And while that range is still intact for now, a continued rise in bond yields and the greenback could see the bottom end of the trading range tested before the end of the week. June gold fell $10.20 or 0.8% to settle at $1322.80 an ounce, giving up 0.7% gains from Tuesday. Prices settled at the lowest for a most active contract since March 21st, FactSet data show. The rise in U.S. interest rates has come as traders increasingly start to price in 4 interest rate hikes in 2018 from the Federal Reserve, rather than the 3 signaled by policymakers. In a recent note, Edward Meir, independent commodity consultant with International FC Stone, said he believes gold will have difficulty withstanding what we see as a rising trend in both the dollar and U.S. security rates, and see both pushing higher, at least going into Friday's key Q1 GDP reading. Higher yields can dull the investment appeal of non-yielding bullion. It is also true that accelerating inflation can eventually lure investors into the shelter of gold, meaning bond market moves tend to have mixed implications for the metal. And that, so far, however, rising yields have driven gold lower. And that kind of brings us to what some analysts are saying about gold and the bond market, and that they're actually saying that what we're seeing now with the bond market is a foretaste of what is to come with gold going up tremendously. And others have, and that's an area that I'm not as familiar with. We saw Silver Bean Counter talk about it a bit, and it's quite interesting and fascinating to see how this all comes into play. And even as such, it's difficult to really predict. The ICE US dollar index was up 0.5% at 91.19. Its moves impact the appeal of dollar price commodities, including gold, to investors using other currencies. U.S. stocks, meanwhile, struggled on Wednesday as the prospect for higher yields elsewhere made equity investors uneasy. So here we can see silver's price movement here. It's kind of tightened up a bit, as we saw. Is that a sign of what's to come? Some think it is. So we shall see. It fell 20.1 cents or 1.2 cents to 16.50 an ounce. Very, very interesting indeed. The gold to silver ratio, which has fallen for a time to 78, has climbed back to almost 80 as a result, noted analyst at Commerce Bank led by Karsten Fritsch. Silver has clearly been dragged down by base metals in recent days, whereas gold has fared somewhat better despite suffering some losses. And again, that bolsters the point of how silver is being used more and more in industrial applications, in the biomedical field, and in technology. So it's seen just as much as in fact, in some cases, in many cases, especially here in the West, more so as a commodity rather than as money. Quite interesting. The analyst also remarked on a mixed demand picture for silver, citing slightly conflicting reports. According to the CPM Group, a global silver demand this year will grow by only 0.8% to 934.2 million ounces. The CPM report says this is the lowest demand growth since 2012. Accordingly, global silver market is likely to show a surplus of around 44 million ounces in 2018. So there you have it. We've seen studies saying that there is more demand for silver, but it looks like that this forecast is saying that there will be an actual surplus of multiple millions of ounces, 44 million in 2008. Thomson Reuters is more optimistic in the World Silver Survey 2018 it compiled for the Silver Institute. GFMS envisages a small deficit on the silver market in 2018 after the supply already failed to keep pace with demand last year. So it's a mixed bag, really, with everything that's out there with the precious metals. But fascinating reports indeed. Just goes to show you that every day is a new day, and what you may think could affect precious metals in one way may not have the effect because of some other factor that comes into play. Now, it is quite interesting, and I think we can pretty safely say that probably the largest indicator with precious metals pricing is going to be the dollar index. And with that, obviously, it affects oil prices as well. So I think when we see those factors, especially the dollar index, typically, although not always the case, we will see gold move one way or another, and silver as well. But post your thoughts below. I'd like to extend a multitude of gratitude y'all for watching, and encourage you to please rate, comment, and subscribe.